Markets are reeling. We started off the day with a really strong run. The S&P finished the day down 1.5%. So a big move from 5% up to 1.5% down. Apple was one of the leading culprits, right, down 5% itself. As new tariffs are about to hit tonight at midnight. So obviously this isn't just noise. There is it's not just panic. This is one of the. I mean, there's only a few shifts in market sentiment this fast that we've seen in history. 2020, 1987, the washout phases like 2008, 2002, bear markets. In today's outlook, I'll show you some key levels I'm watching to see whether or not this turns into something more than what we're having here, if it's going to go beyond. How the sector rotation is giving us clues about where the market's headed, and what intermarket signals like bonds and gold and oil are telling us about risk appetite right now. If you're wondering whether this is a buying opportunity now or the start of something significantly more, as in a bear market, stay tuned. We'll break this down. So let's go ahead and get started. Today is Tuesday, April the 8th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can sign up for our Market Outlook email by signing up right here. Also, you can either subscribe to our notifications when these posts get posted with that button, or come down here and just click this is probably easier, just click that bell. Watch some Market Outlook live videos where I take a look at old Market Outlook trades we've done in previous videos. We talk about managing them, and then come down here, click the heart on this post to like the tweet, and this thumbs up icon to take you to where you can like the Market Outlook Facebook post. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we ended up down. We did not get a new low today, but we did close below yesterday's close. Obviously another big range. So yesterday the range was 411 points. The average is at 145, and that's a high number. So yesterday's range was 411 points. No gap. The gap was filled in. Same thing here today. The gap was filled in, so you don't have to count for the gap. 357 points. So well more than double the already really high average. So when you have big ranges like this, that means the bulls and the bears are just duking it out. As we've seen multiple big moves intraday. I'll show you the chart here in a second. There's been big moves to the upside and to the downside. So they're duking it out here. That's how a washout phase. I mean, the washout phases of corrections, of bear markets, they're huge. The moves are huge. And we are in the washout phase right now, potentially, of this correction that we're having, because we're sitting getting closer, at least, to the 200-week moving average, as you'll see here in a second as well. We are more than 10% still, 11.5%. It's hard to get too far below the 30-day moving average, because it keeps falling too. So we are well extended below the intermediate lines, well in the reversal zone. Short-term sentiment's a little bit improved, but remember, it really doesn't matter until it crosses 40. Once it crosses 40, then we can kind of see, okay, are we going to really take off here for a new near-term rally, get that intermediate line to turn bullish, or is it just going to flare out and be bearish, and we stay bearish in the intermediate line? So as of right now, with the near-term line in bearish territory, we're still stuck. The momentum line is below it. It would be ideal if it was above it, because let's say tomorrow we have a good day and the near-term line rallies. You need the momentum line to get above it, and ideally you need the momentum line to get to 80. And so it would take a really good move. Now again, the ranges are huge. And there's going to be, one of these days is going to be a big up day, right? Because that's how it works. I wouldn't be surprised, like we had today, a 5% gain in a single day, right? We'll get a green tag on the zigzag chart in a single day, considering, again, how big the ranges are. So keep that in mind. That's the kind of move that we might need to get the escape velocity off of this really significant bearish sentiment here. The market sentiment still falling in bearish territory, and as usual, all the major indexes have similar. Sorry, I didn't notice the camera. I don't know why it keeps doing that. The other indexes are showing similar patterns here. As you can see, the intermediate line is in the reversal zone. The market sentiment's bearish, and short-term sentiment's slightly improved. And we were down. We were actually up yesterday slightly, obviously back down today, and not down 2%. Again, considering the range was again more than double the ATR, and that ATR is very, very, very high number right now. Looking at the Dow Jones Industrial Average, you again see a very similar pattern. We got that big time doji. We get a little bit of a engulfing pattern, but it's like a bearish engulfing pattern that usually get on the upsides. We got it here on the downside again. Very similar. Market sentiment now is below 40 for the Dow Jones Industrial Average, and then finally, if you take a look at the Russell 2000. Again, you can see another down day. Did not get a new low today, but came close to get a new low. So its short-term sentiment's not as strong, but it's still above 20, and the intermediate line's down, and your market sentiment has actually crossed below 20. We are 13.5% below the 30-day moving average, which again is an extreme for these markets. Let's take a look at the weekly chart. Remember that weekly chart was showing such a big bearish candle here, still is. Down to that 10% mark, very, very extreme again candle. Considering that we got the death cross, suggests that again it may be months before, as you can see when you look at prior other death cross environments, which is what you get on the weekly chart when you are in correction mode. You get pink shading for quite a while. Some of these. 2018 didn't last as long, but still, we're talking weeks here. Every period here is a week, so we're talking weeks and weeks of pink shading, and potentially months, as we saw in 2022, and even the early stages of 2007, 2008, when we were in the correction stage of that particular bear market. If you take a look here at the three green arrow chart, we obviously have three red arrows across the board. And again, nowhere close. The stochastics would be the closest to getting the first green arrow, so that we're not having pink shading anymore. But pink shading all across the board. We are way below moving averages still. And remember, you get your biggest up moves and down moves when you're below moving averages, especially that 200-day. So we're way below that. That MACD has hit a key level. So getting below 2 is pretty significant in terms of from a pullback standpoint, right? Because if you get below 2, it generally means the pullback is going to turn into something more. In this case, turns into a correction. Getting below 3 now is significant in that the washout phase of this correction may be done. It doesn't mean that we won't go down a little bit more, just like yesterday. I told you yesterday, even if we rally, it doesn't mean that we won't go down a little bit more before we're done. So same thing, we might go down a little bit more, but the pressure to the downside is done. Right, is we're down 1.5%. We're only down 1.5%. I know we're down quite a bit from the highs, but because the bulls were so strong early, we only ended up with a 1.5% decline. Down a little bit more, obviously, in the after hours as we approach midnight Eastern time, and in this case, about half an hour. I don't know why my camera keeps doing that. I got to figure that out. So, but with the MACD getting as low as it is, again, suggesting, especially with the divergence here on the stochastics, suggesting that, again, we are in the washout phase here. We are setting the low point. Again, whether this is the exact low point, whether we go a little bit lower, but we're not going to fall another 20% from here. We might fall 1 or 2 more percent from here, but then at some point in time, because these ranges are so big and the VIX is so big and the momentum is so extreme to the downside, the bounce is gonna rip people's faces off, because that's what it does, right? When we're in these washout phases. Again, that doesn't mean that bounce will go all the way up to new highs anytime soon, but it does, because we have so much resistance above us, with the whole entire value area up above us here, but it does mean, though, that we'll get to resistance pretty darn quick. quick enough that it will get people thinking that we might be done and ready to go up to new highs. Erroneously, of course. You can see the negative indicator is still well above 40. The ADX is rising to a high level. Your positive is below 10 still. Again, extreme numbers there. So again, it says that the low is set. The momentum is done to the downside. Again, that doesn't mean we can't go down a little bit more. So I want to stress that. Just because a low is set doesn't mean you can't get a slightly lower low. It just means that the downward momentum is going to stall. So we're not going to have such big pressure to the downside. In fact, I kind of like the fact that we're gapping down here because on very, very low volume, so that when the big volume comes in at the open, we can fill in that gap, potentially, of course. If you look at the some of these other oscillators, like the RSI is so extreme. Like getting down, I mean, we're almost below 20 on the RSI. That getting below 30 is extreme. Getting below 20 is like unbelievably extreme. And your CCI is actually rebounding up to 1, but still negative and still below minus 150. But at least it's rebounding from that extreme level it got to at minus 300. We are way below the Ichimoku cloud, way below the cloud. The rate of change is extremely low. The strength of the trend is so bearish here. Here's that rate of change. When you look at the rate of change over the last 26 days, which is what that is measuring, it's down near 15%. You can see from an example here, COVID obviously had a big drop, and a lot of the speed at which we're dropping here is very similar to where we were in the early stages of that COVID drop. But as you can see, there aren't very many others, like 2008, a washout phase of that particular bear market. We also fell, but not during any of the other stages, like the correction stage, or the move to and through the 200-week moving average, where we actually turned from correction into bear market here. That got down, but then you didn't get down to the 15%. So, this is a big number that, again, we only see literally a handful of times in history. 1987, 1998. I've seen some instances of 1998. Of course, 2020. I mean, those were all corrections where we dropped to the 200-week moving average, like we're doing right now, but we didn't go through the 200-week moving average, like 2008 or 2002, where we had big washout moves there, but we were already well below the 200 weeks. So we're in a washout stage, but we're in a correction washout rather than a bear market washout, which means that there's a good chance we might avoid breaking that 200-week moving average and actually staying and getting a bounce off of it. It might not be like COVID where we bounce back up within months. It might be more like 1987 where it took a lot longer to get up to new highs. But at the very least, we're going up to new highs. The speed of it might vary. Might be, we don't know what the speed of it will be, but at least we're going up and we're not breaking the 200-week with an extended run below it, which is what, insidious bear markets are. Let's take a look at the Bollinger Bands. Of course, again, way below the Bollinger Band. Not as much as we've been, and that bandwidth is extremely high, and we're way below the Keltner channel still with the momentum, which is lagging. It's going to end up being very, very significantly lower. So, again, the more we are down at these levels, and I didn't mention this, but remember, the how far below the 17-day is also something we look at so that we can see whether the MACD is going to jump. And again, we are way down below that, 10% below. I mean, that is extreme. It's so extreme to be this far below. Again, that's why I say this typically means that the low is set. Here, let's move this to 10% now that we've gone a little bit lower. So you can see we're past that 10% mark. And again, for other instances that we are past the 10% mark was COVID. And the very end of 2018, the beginning of 2015, 2011 there. And again, you can see all these instances, and of course the washout phase of that bear market. You can see all these instances that were not bear markets, where they were just corrections. This kind of momentum in the short term set the low point. Again, volatile around it, but at least it set the low point without going further. The only time we did was COVID, and obviously there was a reason, because we completely shut the economy down. And while it may seem like we're shutting the economy down right now, the reality is we're not, right? Not even close to what we did there in COVID. So the economy still would be functioning. So that's why I think we're more likely due, a kind of the end of the COVID type bounce, 1987, 1998 type bounce, than we are, a break below the 200-week moving average right now. We might ultimately break below that 200-week. You can see here that we're still easily above it, so we might, but you can see to get below it, especially now, there's some significant support here. So the first time getting below, especially when you're so far, like the 50 so far up above, here's the difference between the 50 and the 200-week moving average. Sorry, again, I don't know why the camera does this. But the gap there between the 50 and 200-week moving averages, you can see, is still very, very high. So that first drop to the 200-week, especially when the gap is so big and the support's still there, it's hard to just keep going, right? Even COVID didn't do that, right? You can see here, because COVID was also a pretty decent drop down. We got to the 200-week. We had 1 week further lower, and then we rebounded. And within 3 weeks, we're back above the 8-week exponential, and we just kept going up from that point. So, and again, we actually weren't as high then as we are now. Now we're in the 20% move, 21% up above it now. The 200-week moving average. So we're pretty high now, but it's we're not going to necessarily break. Let's go back to the 5-year. We're not going to break this and just keep dropping. If we do, we'll probably go down to the 440s. That's going to be a support level. 475 or 470 is a support level. Which again seems like it's far down. 26 points down lower, but considering that we've dropped in the last 3 weeks, from 576 down to 496, about 80 points to the downside. That 20 more points is not that big of a deal. And from 613 down to 496, now we're looking at more than 100 points. So 20 points in that context is a pretty small move, and that's what I mean by when I say we've set the low point, even if we might go a little bit lower, but the downward momentum is going to stall as we approach these significant support levels. Let's take a look at the intraday chart, and you can see again we're retesting those lows. We gapped up and then we filled in the gap. You can't fill in the gap. At some point in time, we're going to gap up and just run away. That's a runaway gap where you gap up, standard deviation or two, and we just keep going from the open. We don't fill it in. And it looked like we had that chance this morning, but once we got here and we started to break into the gap, then a good chance we're going to break the rest of it. And we did by the afternoon, and then some after that. And we ended up closing above yesterday's low. So it was a higher high, higher low. We closed above yesterday's low, below last week's low point. And then we'll see. Again, all the volume still in the 4 week is up here. So again, don't be surprised if we don't get some big moves. Again, to the downside, which remember we're at 490 right now. So we are pretty much at today's low in the after hours trading at 490 as we head into another half an hour before these tariffs kick in. And of course, not surprisingly, the volume and trading range again were extremely high, 35 points. The volume not as bad, but still you can see the average is very, very high. It's rising at a rapid rate here. Very, very high, and you can see well above 3% now. Again, the only other time that we've been above 3% here on this was COVID. So very, very significant move. We did get over 3%, barely, but we got over 3% here during the credit crisis there, and where we set the low point. We retested it multiple times with some big up and down moves, but at least we set that low point with that extreme. And again, that's where we're at right now. That's the extreme we're at right now. In fact, if I were to go back, so you can see, let's go back to, so we can see 1987 and 1998, some other analogs to what we're seeing right now. So let's go to 1980. And we'll switch this to SPX. And again, we're at 3.15% there. So if I were to look at, there's the bear market, of course, but the washout phase, right? So below the 200, but there's the washout phase of the 2001, 2002. So we got above 3%, and the washout phase of that bear market, there's 98. So we got to 3% at the very bottom of 1998's decline. Again, did not turn into a bear market because it stayed above the 200-week moving average. And then 1987, we got up to about 5%, right? Big move. But again, we went from 1.7 to 2, and then from 2 to 3.82. Here, let me zoom in so we can see this a little bit better. So we went from 1.7 to 2.06 to 3.82 in one day. We crossed 3 and then got to 5. So we got there pretty darn quickly. But the idea is, like, we are extreme right now. This is an extreme level right now. And again, while we might go a little bit higher because the moves the last couple of days are well above 160. So we can keep going up, might get closer to 4% because it's lagging by the time we get done. Remember that it keeps going up after we rally because those first few up days are also big ranges. So it's going to keep going up. Probably will end up hitting about that 4%, or at least close to it by the time we're done. But again, it's another sign that, that while we may get some big ranges still on an intraday basis, we're not going to drop, 10% from today's close, in another day or two, right? We're not in the Great Depression type era. And for all we know, we could be, but very, very, very low odds from a technical standpoint here. And then finally, the volatility, the VIX, which is another sign of the extremes, and the sign that a low is set, is the VIX above 50, right? It's very, very rare for the VIX to get above 50. And not only is it above 50, but it's above the 125% mark. Again, very, very rare for it to be above 125%. Here, let's go to a daily. Let's go to a weekly chart. So here we are right there. If I follow my cursor along, you can see we just don't get up to, and you can also see here in the 50s, we don't get above 50. COVID and the washout phase of the bear market. It's the only other times we get this high, and the VIX is extremely high. The VVIX is also extremely high. Again, that's not common. If I were to zoom out on this one, so you can see again the level of the VVIX, which is the volatility of the VIX of the VIX. Again, the only other time here, let me go to VVIX. It's been above 170 was again in August of 2024. So kind of a crazy move there today that I got back from Ghana. And then, again, COVID there, and then you can see 2018, 2015, all these levels. When we got up to this 170 level, it didn't stay there, right? We came back down very rapidly. So again, another sign that we've set the low point here, even if we haven't maybe necessarily set the lowest intraday low or the lowest closing low, but around this area is where the low ultimately will be. We may have set them. For all we know, maybe today is the lowest closing low. Maybe yesterday was the lowest intraday low, for all we know. But most likely we might retest those still, and with all these big ranges that we'll get both to the downside and to the upside over the next day or two. And I didn't point it out, but I showed you this chart. There's been big up and down moves here, big up and down moves, which means again that the bulls are around here, right? We've had some big bullish moves on an intraday basis yesterday, and then overnight today. So we've had some big bullish moves here. So the bulls are in the area; they're not absent. Otherwise, we just go down. As soon as the market opened, we would go down every day. But the bears are still in force, but the bulls are so we're at a stalemate, and that's what happens when you're creating tops with very small ranges, and when you're creating lows with the big ranges. In this case, extreme ranges, but generally bigger ranges, right in the 2% range. Like I said, this being at 3% is huge extreme. All right, now let's talk about what's driving this price action here. So let's take a look at the asset class comparison chart. And again, just look at today. And remember, it was a wild ride yesterday. It was a wild ride today. As we started up 4%, the S&P got up to 4% gain early in the morning. The NASDAQ 100 was almost at 4.5%. The Russell 2000 there just over 3%. Everything was doing good. Developed markets were up. Emerging markets were up. Everything was up. Real estate was up. Gold was up with some weakness in the dollar. The dollar stayed weak and actually closed closer to its lows. But you can see bonds, which started off down, so bond yields were up. Bond yields ended up quite a bit by the end of the day today as stocks just plummeted. We went from, again, up 4% down to eventually down to 3% loss at one point before the rally up to a 1.5%. And that, remember, we're now in the after hours, we're kind of trading down to these lows on the S&P or a little bit lower. The Russell 2000 just getting hammered again. Was up 3%. It finished down 4%. And gold ended up staying positive, outperforming. The dollar was down, but still outperformed as treasuries basically became an equity asset class. So let's take a look at the 10-year yield. You can see the 10-year yield jumping to 4.26%, back above the 200-day moving average, back above its 30. Remember, there is a ceiling for the 10-year yield at the Fed funds rate, right? The 4.25, 4.5. It can get up inside of that 4.5%, but there's a ceiling in there. If we're going to get above it, like we're starting to at the end of the year, beginning of this year at 4.8%, if we're going to get above that 4.5%, stay above it, then that signals inflationary expectations that the Fed would have to hike rates for, not cut rates. So I think the biggest thing we're seeing here, and you see it in TLT as well, the biggest thing that we're seeing in the same thing that we're seeing in the futures. There's the futures right now down, 2.5% in the after hours. But here's TLT. Again, we were pretty bullish getting above the 200-day moving average. We've really come down quite a bit in these last 2 days. In fact, this is, if I take a look at the rate of change just over the last couple of days for TLT, that's a pretty significant move for long-term bonds here. Let's take a look at TLT. So you can see the biggest move that we've had in the past year in 2 days. And if I were to zoom out for some context on this, you can see the biggest move we've had in the last 5 years in TLT to the downside. A big, strong 2-day move to the downside. In fact, we have to go all the way back to COVID to have a bigger 2-day drop, and we had a couple of them. We had an 8% 2-day drop, and then we had a 12% 2-day drop. But both of those sparked some pretty significant rallies, and so I expect that you'll probably see this drop here also spark a relatively significant rally. Here's a 2-day drop that we were already kind of dropping on, and then we ended up bottoming out just a few months later. That we were also right around this level in terms of 4%. Of course, at the washout phase of the bear market, after some big rallies, we had some declines, pretty significant 2-day declines coming off of those highs. So we're not parabolic here, so it's not like we're coming off a significant high. So I think this is more kind of a significant oversold move to the downside, and I don't think that bonds and bond yields, for that matter, will be able to maintain such a significant move. Here's on the 4-day chart again, getting a new 4-week low point as the red line comes back up, and again, I because the green line's up too, I actually wouldn't be surprised if we don't get more 4-week lows and we end up the red line gets below 70 before the green line gets below 70, as the range is about in the middle of where it is throughout the year in terms of the 4-week range. So it can still move in either direction. So technically, it still moves to the downside, probably retest this 85, and there's a chance that could happen. I don't think there's much more downside to it than that, again, considering the limit that you see on the 10-year yield. And of course, when you look at gold, that's always the other side of that coin would be the dollar. And let's take a look at the euro, since the euro's trading right now in the after hours. You can see the dollar is falling. So the euro is rising. That means the dollar is falling. And this is the biggest component of the dollar index, makes up about 60% of it by itself. And so you can see it's actually at recent highs, close to recent highs as of right now. Remember, this candle just barely started a few hours ago, so it will go out. This candle that I got my cursor on will go throughout the rest of the day tomorrow. And of course, that's going to have the weakness in the dollar is going to be beneficial to gold. The gold's had this big drop. To the point where it got kind of a semi bull by the dip signal on the market forecast, got a bull tag on the market forecast. So there's an opportunity for, if weakness in the dollar persists, then we can bounce right off this bull tag and gold can make another run up to, especially considering again the safety nature of the trade. So, and then finally, the other intermarket relationship that's kind of giving us some signs is crude oil. Look at that drop that we've seen in crude oil. This is a tremendous drop. Remember, crude oil, this can be a reflection of economic growth expectations. And look at the last 5 days. So this day is also, the last few hours, so it's going to go through tomorrow. So that cluster might not be there by the end of the day tomorrow, depending upon if we get a long lower shadow or not. But let's go back to the rate of change for crude oil and take a look at this 5-day decline that we've had and put it in some context as to how severe this move has been, how extreme this move has been, down 20% in 5 days. That's a significant move to the downside. We did see that, towards the beginning stages of 2022. But that was coming off of a tremendous rally in crude oil, so it was just a kind of a recovery type move. Obviously, COVID, we had sharp economic growth expectation declines because the economy shut down, and then at the worst stages of again, we were well below moving averages there in 2008, and we were getting these kind of declines. We are not, I guess we are kind of below moving averages, obviously below the 200-day, but we're technically also below the 200-week as well. There's the 200-day, and we're breaking below the value area and pushing lower. But if you look at the 200-week, we're also we're in bear market territory for crude oil. I mean, that's a big drop. This is a significant move. There's not much support down here. Again, so it's for this to be falling and the 10-year yield to be rising. It kind of goes. One of them's got to give because they usually kind of move hand in hand with inflation expectations and economic growth expectations. So one of them is going to give, and I think it's actually the yields that's going to give, and this weakness in commodities might be telling us something about whether or not this will actually just stay a correction. Because this washout phase will produce a bounce, a bullish move with double digits in the green tag. So it will be a big explosive move. And whether or not we have the economic growth expectations, which ultimately lead to higher earnings, and that's what makes stocks go up in the long term. Whether or not that persists, according to the commodity market, the idea is that they're probably not going to be saved by strong real GDP growth, and ultimately may head into a longer term bear market than what we've been associated with. I mean, everybody's been looking at these corrections as bear market, like 2022. Oh, it's a bear market in 2022. We never dropped below the 200-week moving average. Same thing with COVID. We had a big drop in a short amount of time. We dropped below the 200-week moving average for a full week, and we bounced right back up above it. So yeah, having an actual extended run below the 200-week moving average where we do most of the damage, right? I mean, we have had a lot of damage just to get to the 200-week. Most of the damage in a bear market is actually below it, and so the commodity market here may be telling us something about what we can expect there. That's a possibility going forward. Even if, like I said, in the next short term, we're going to get an explosive move to the upside. And it won't take very many days to get there. So most of it will be gone before you know it. So that's why I say it's important right now to know that the low is set. Even if the exact low point might not be set, the low in terms of the area is set. We might go down a little bit lower. We might go up and down around this area. But this area here, where the bulls and the bears are really hammering at each other, this is where we're set. And once this washout phase finishes, we'll transition to a quick rally that, like I said, half of it will probably be gone by the time you realize that we're actually in that stage of bouncing off of the corrections washout low point. Let's take a look at the breadth. The breadth is starting to deteriorate a little bit, which is actually a good sign, because again, it means we might be a lot lower to, closer to the actual low than not. As you can see, we're down to minus 71. We're almost below minus 500. In fact, another day like this, and we will be below minus 500. Remember in 2022 when we got below minus 500 during that kind of first stage of the bear, to the correction on the move down to the 200-week moving average, and then we rebounded here, or at least that first kind of pullback stage, and then we rebounded when we got it back above. So you get below 500 for the first time on a correction. Then we come back up above that. Then we'll see if we get back above zero, then we have a good chance that we might be done at that point. Let's take a look at the number of stocks above their 50-day moving average. So let's go over here and let's look at some of these other breadth indicators that we like to look at. Remember, yesterday they were extreme, and they're very extreme now. Like, this ratio is above 3. Like, that's the highest this ratio has been in a very, very long time. Like you have to go all the way back here to the beginning of 2018 to get the ratio up this high. And before that, it was the low point here in 2012. We got above 3, and the low point here, this kind of brief low point in 2011. You can see this the flash crash low point in 2010. So this is an extreme level, and this goes to show that the breadth is so extreme. The number of stocks above the 50-day moving average is below 10% now. That's an extreme low point that we saw in 2022 a couple of times that marked the low point, at least a temporary low point of those particular washout moves. I mean, those were both kind of washout moves there in June and then in October, the multi-leg correction. The number of stocks above below their 200-day moving average is also down to an extreme. It's below 20%, which again is unbelievably rare to get there. We saw that again during the washout phases of both washout legs of the 2022 correction. We also saw that in COVID. We also saw that in 2018, again, during the washout moves of those. So, we are in the washout move of this correction, which means, again, the low is pretty darn being close to being set here, way below the 20-day average as what this PPO is measuring. Again, has in the past marked the low when we've got to this point. If you look at the net new highs and lows, again, we're not as extreme as we were yesterday, but still, below 2,000 is an extreme. It's very much an extreme here. Very, very much an extreme. And you look at the new lows here, 2 days above 1,000. So, like we're going to be done. We're going to be done sooner rather than later, and we're going to be rallying very, very quickly. Potentially, the beginning of the rally might be, like, I don't know if it'll be tomorrow. I still think we're kind of washed out in this process. But by the end of the week, we might have that first, face-ripping rally that starts us off to that zigzag chart, right? Because again, we're going to get a new green tag on this chart, and considering how far below the moving average now, this was, just like that ended up being a quasi 5% decline, ended up being like 4.6. This is what our 5% rally essentially did. Didn't get all the way there because it only got to, I think this one got to 4.6. 4.62. This one got to 4.3. That decline. So it looks like that's our quasi 5% rally that got close to the 30-day, didn't ever quite get above it. Got up to that 38% Fibonacci retracement, and then now here we are. It's at the lows here, and remember we're in the after hours right now, so we're actually near those lows in the after hours trading. But when you look at this, we are, we're close to these lows, and these lows here, I guess I need to go to SPX, is right at that 50% retracement of this big bullish rally we had off the October lows, off the last correction low point. Just like the last correction also dropped to the 50% retracement level of the prior move off the COVID correction low point. So this 50% is an important number, and looks like we very well might be down there by at least flirting with it on an intraday basis here sometime during the day tomorrow potentially. But then I believe that we'll be well on our way to a new green tag, which will have a bigger number than just 5% in it. Because remember, we can go right now up to the 200-day moving average, like the type of move we need to get. Just to get to the point of control. Just to kind of give you an idea, from where we're at right now, the point of control is right about 560. So just to get to the point of control from where we're at right now, which is a significant resistance level, and it's way below the 200-day, and it's going to be around where the 30/50-day is by the time we get there. That's a 13% rally, right? That's a big move. So we're going to get a double-digit figure. It's probably going to be 10% to 12%, 13%. And then considering the strength of the resistance that will be there, most likely ultimately end up failing there. And then whether we retest the correction low point and then make a run below the 200-week moving average at that point, that's going to be what we're going to be watching for on that next leg lower when we get the next red tag. Will it be a 5% drop to a higher low, or will it be a bigger drop down to a lower low and a break? The first break of the 200-week moving average, not so bad. The second break is what starts the bear market. All right, finally, let's take a look at the sector rotation. So we'll come back here to the sector moves, and we'll do sector comparison. And let's, again, just look at today alone, and you can see Apple was a big problem today. So we started off very good, up 5% on XOK. At one point in time, we were down almost 4% in XOK, so a big reversal before finishing down only 2%. But that's, again, that's the sector that we don't need to have problems, and it's having significant problems. So let's go here to XOK on this chart. There's energy, which is finally breaking down to its, on the ratio chart, breaking down to the 50-day moving average here. But XOK was the bigger problem. Right, and that's the leader, right? We can't have this dropping. You can see, it's been underperforming. It's, the rotation graph is safety. Look at safety trades, real estate, healthcare, utilities. Even remember how financials were also moving up at one point with them, and industrials. They're all moving in the wrong direction now too. And XOK is in the red, XOY and XLC, and we've looked at this chart before, but. All the safety trades are just blowing it up, and XOK and XOY. This is correction type rotation, and that's continuing, and we're seeing it here with XLK. Look at that weekly breakdown here. Let me zoom out so we can see some context on this move. Again, both lines are below 100, which means we're in the lagging category. We are well below the 8 and 17 day, and the relative strength chart here is just breaking down in a very, very big way. In fact, I talked about high yield as breaking down. Look at investment grade. Look how much investment grade is breaking down. In fact, you're getting a death cross now on investment grade relative to treasuries. This is a highly correlated index with the S&P 500. It's breaking down and getting a death cross. Again, that happens, as you saw during corrections. You saw in 2022 and COVID over here in 2020. These are pullbacks where you don't break it. This is a correction where we do it. Again, corrections, the difference between a correction and a pullback. If this is a pullback, we're going to be back up to new highs within a couple of weeks, right? Because that's what pullbacks do. Obviously, that's not going to happen, which means we might not, we're going to be done. Remember, a correction on average, you spend 100 plus days below the 200-day moving average. We spend a few weeks, and we typically bottom out about 15% plus or minus a little bit below the 200-day moving average. We're actually getting relatively close to that, but even then, we're right around 13.5%. So we're getting pretty close to the bottoming out of the correction, right, at the typical stage. But if we're going to be 100 days below, that means we're going to bounce off these lows after we get the washout, maybe a little bit of a retest. It's going to be a slow grinding process to get back up to new highs, if we ultimately do, without failing and turning eventually into more of a bear market, which I'm leaning more in that latter direction than I am the former. All right, that brings us to our trade idea of the day, and it's kind of hard to find a stock that hasn't like below its 200-day moving average. But there actually was Gilead's one that is just starting to break down. It's been so bullish here, and it's kind of held up much better than obviously technology in a lot of those areas. But it's now not so much because this is more of the technology area portion of the healthcare sector. Dark pink shading in a red line, short-term sentiments bearish, crossing below the intermediate line. The intermediate line now in bearish territory. Market sentiment pretty high, but rolling over. We're further below the moving average than we have been for most of the past 52 weeks. If I take a look at the weekly chart, we are just getting the red arrow on the weekly candle today, which means we're breaking below the 10-week. That PPO is high and falling there. If I take a look at the the 3 green arrows, obviously we have 3 green arrows on this stock, but if you look at this, we're barely breaking the 50. There's a pretty big gap between the 50 and the 200 where the point of control will be. So there's some pretty, and we're above the value area. We haven't even moved into the value area yet, which means it's easy to go down. If and when we start to break down, we've had a breakdown to the 50, we bounced up, we failed, and now we're looking to, kind of have more of a pullback here. Remember, pullback doesn't really start till you break the 50. So this is kind of noise when you're up above it. Even just because we were so far above it, it makes the drop bigger, but still is ultimately just louder noise than some of these other moves, which did not get above it here as far and fell, and that's a little bit lower noise. But so that's the only difference. So it didn't break the 50 until now, and now we're in pullback mode. If you take a look at some of these other oscillators, like the DMI, you see here that we're above 30 on the negative, and now we're below 20 on the positive. The ADX is already above 25. That goes to show just how strongly bullish it was and how much of a reversal it is now from that strong bullish trend to a bearish move, getting below 40 in the RSI for the first time in a long time, getting below minus 100 again on the CCI, the Ichimoku cloud. We had such a strong bullish trend, it's gone. We're flirting with the bottom of the cloud now with a negative rate of change, and the flirting with the we have a weak bearish trend flirting with intermediate strength bearish trend there. And then finally looking at the Bollinger Bands and the Keltner channels, we are below the lower band and below the lower Keltner. We finished off the lows, but we're below the lower Keltner channel as well. The momentum, the bands actually were outside the Keltners. Now they're not because of the move off the low, but they probably will be tomorrow as that momentum is shifting back to being more bearish and making potentially another run to the downside. So what I decided to do here, if I can get to it, is let's go to Gilead. What I decided to do on Gilead was to sell a put spread. So sell that low 20 delta, buy 1 strike away for protection. Position sizing for it looks like I didn't quite get a full position on here. I could have gone up to that $500. So we got priced pretty well. I actually was positioned at $500, but we got filled in at a pretty decent price. So getting about what that ultimately ended up being, about a 3-to-1, 1372 divided by 378. Yeah, about 3.5-to-1 reward to risk ratio. So that would be over $1,500 if I did have the 500 risk. So pretty good return there, and not very much risk for this stock if it were to continue to move towards the 200-day, which is again what pullbacks do: break the 50 and work your way towards the 200-day moving average. Because remember, that gap is pretty large for Gilead between its 50 and 200-day moving averages. So we just need to get down into this area here and stay down there by May expiration for us to get the return that we're looking for on that stock. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us on marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.